In this video, I'm going to share with you the only lessons that you need to become a consistently profitable trader. These are the exact lessons that have allowed me to get funded over $400,000 in the last 90 days. I'm going to walk you through every single lesson. There are 4 lessons in total. Lesson number 1 is strategy hopping. Lesson number 2 is uniform risk management. Lesson number 3 is a clear directional bias. And lesson number 4 is backtesting your strategy. I guarantee if you stick around until the end of this video, and if you implement these 4 key lessons, you will become a consistently profitable trader. You're genuinely going to get so much value from this video. Let's dive in. So this right here is the 4 lesson framework. And let's just start with the most important, which is lesson number 1. And if you don't understand lesson number 1, you will waste years and years of your time trying to find a profitable system. And this is probably the number 1 problem that most traders face, and that is strategy hopping. I remember when I first started trading over 7 years ago, I wasted the first 3 years of my trading from literally strategy hopping every single week. And the biggest problem that most traders face is they will incur 2 or 3 losing trades in a row. And then what they will do is then strategy hop to the next strategy because they think that the strategy doesn't work. And so what you need to do is stick with a strategy long enough so that you can genuinely see the results of that strategy playing out over the long term. And this is also known as shiny object syndrome, where people are constantly looking for the next big thing. They're looking for the new and shiny object. They're looking for the newest trend, the newest strategy. And what I realized is all along, I genuinely had a profitable system even at the start of my trading career. And so you need to develop the discipline of sticking to a strategy, even through drawdown periods. Everybody's absolutely happy when the strategy's performing well, win after win after win. But as soon as there's like 2 or 3 or 4 losses in a row, and you're going through some sort of drawdown period, that is when most people strategy hop. And so what you need to understand is drawdown is normal. And so getting comfortable with it, not strategy hopping when you are in drawdown, is absolutely vital. So, a great question that you need to ask yourself is, are you comfortable with the maximum amount of drawdown that you've seen? Let's say that this is 6 or 7 losing trades in a row, which is genuinely realistic for most trading systems. If the answer is no and you're not comfortable with that, I guarantee that you will eventually fail. Why will you fail? Well, it's very, very simple. Because you will go back to lesson number 1 and you will then strategy hop. And this process repeats over and over and over again. And so if the answer is yes and you are comfortable with the maximum amount of drawdown that you've seen, then I guarantee that you have the right mindset to succeed, because drawdowns are inevitable. And let's say that you are incurring a 5 or 6 or 7% drawdown, then you will have the right mindset to work through the drawdown. And it's the consistency and discipline of this that genuinely separates profitable traders from losing traders. And I just want to be fully transparent here, guys. Over the last 6 months, I've worked my way out of multiple 6 or 7% drawdowns. And then off the back of that, I've received payouts or even past prop firm challenges. And a lot of this genuinely just comes from experience. The more times that you've been in a drawdown, the more times that you've got yourself out of the drawdown, it really helps give you the belief for then when this happens again, you've kind of seen it before. You've kind of seen this drill before, right? So this inner confidence from experience in these drawdowns before does make it a lot easier to continue to execute your strategy day in and day out. There's also a lot of ways that we can take advantage of these drawdowns, but I'm going to get onto that in a further lesson. So lesson number 1 was incredible. However, if you do not understand lesson number 2, you will continue to blow accounts over and over again. A huge problem that so many traders face is they calculate their risk completely based on their emotions and based off how they feel. However, what you need to do is use uniform risk. And all that simply means is every single trade, you are using consistent risk within the market. At the end of the day, I'm not here to tell you how much you should be risking every single trade, but whatever it is, it needs to be consistent. For me, genuinely, I fit into this bucket where we're risking 1 to 2% every single trade. And let's say you pick 1%. You need to be consistent and use 1% every single trade. It doesn't matter how you feel. It doesn't matter about the previous outcome of the trade. It doesn't matter if you've just lost the last 5 trades in a row. It's the discipline of sticking with consistent risk that will genuinely transform your trading. The problem that most traders face is they increase risk when they lose. However, no matter the outcome of the previous trades, you need to continue to use the same risk every trade. You also need to remember that every single trade is independent. And just because you lost the previous trade does not mean that you will lose the next trade. And this is, of course, vice versa for wins as well. Just because we've won our previous trade doesn't mean that I'm just going to then increase risk because, I'm going to win the next trade. It doesn't work like that. And so this is a uniform distribution graph. And all this simply means this is our function right here, which spits out a probability. And all that means is that every single trade is independent. Every single trade has the same probability outcome. And of course, this is given that you're only executing A plus setups. And so A represents trade 1, B represents trade 2, and the probability of each trade playing out is the same, and that is why you need to use uniform risk. Of course, all of this falls apart when you're not taking A plus setups, and that's why filtering out all of the poor setups would be very, very beneficial to you. And so tied into uniform risk management, a great question to ask yourself is, do you know your maximum losing streak? If the answer is no and you don't know what your maximum losing streak is, you need to work to understand your risk of ruin. This just means, i.e. blowing an account. You can do this by simply backtesting your strategy. I've done it over hundreds and hundreds and hundreds of trades, and therefore I'm very comfortable and I understand what my max losing streak is. And for me, it's around 7 losses in a row. So if the answer is yes, and you do know your maximum losing streak, you need to ask yourself, are you in a drawdown? If the answer is no and you're not in a drawdown, I recommend to continue to use standard risk. If the answer is yes and you are in a drawdown, again, because we use uniform risk profiles, I recommend to continue to use standard risk. This could be 1 or 2%, depending on what you prefer. However, some people like to use reduced risk. The reason why somebody would do this is because it gives you more opportunities. Let's say that you normally risk 1%. If you are in a drawdown, let's say 5%, some traders will reduce their risk by half. So you're now risking 0.5%. You've then just doubled the opportunities in order to try climb out of this drawdown. Regardless of which approach you take, increasing risk is never an option. So please keep that in mind. The next thing you need to ask yourself is, are you in a 6% plus drawdown? And this is based on my historic data. So this is my thought process. And again, if you're not in a 6% plus drawdown, you should keep using standard risk, or depending what type of trader you are, you could use reduced risk. And this is where it gets interesting. Let's say the answer is yes, and you are in a 6% plus drawdown. I recommend buying another funding challenge. And you're going to have to hear me out here, guys. Let's say that this is your equity curve right here. And let's say this dotted line is a 6% drawdown. So that's this area right here. The reason why I recommend buying another funding challenge is because every single time that we've seen a drawdown of say 6 or 7%, because this is around the maximum drawdown that I've seen for my strategy, what often happens is price will then rebound out of the drawdown. So let's say that you did buy a challenge right here. Well, what happens when we come out of this drawdown? Not only will your first challenge that was in drawdown will be back out of drawdown, but the second challenge that you've just bought, that will then be past, or at least very, very close to passing. And therefore, this is an advanced prop firm scaling technique that I have genuinely had a lot of success with, and a lot of my exclusive members have had a lot of success with this as well. So this is more of an aggressive approach with scaling funding capital, and this is a great way to take advantage of your drawdown periods. At the end of the day, you might find this to be too aggressive for you, but I'm just sharing with you an effective way that has worked very well for me in all of my members. So that is lesson number 2, which is using uniform risk management. And lesson number 2 was incredible. However, it means absolutely nothing if you don't understand lesson number 3. And a huge problem that so many traders face is trading in the market when the conditions are not right. I personally trade a trend continuation system, and therefore I need trending conditions in order for that system to genuinely have an edge within the market. So the solution is to only take trades when the market is actually trending. If the answer is no and the market's not trending, then you should be doing absolutely nothing. This would just literally be a consolidating market. However, let's say that we have a clear uptrending market. We then have a clear directional bias, and therefore we can look at taking a trade with the trend. And I remember I used to have so many issues with not being patient, and I found it very difficult to actually sit on my hands when the market conditions were not right. Because at the end of the day, capital preservation is number one, and no position is actually still a position within the market. Therefore, you need to ensure that you become disciplined and patient, and to only execute your trades when the market conditions are just right. A great way to do this is just by turning up every single day consistently. Do not deviate from your trading plan. Continue to use correct risk management, even during drawdown periods and even when your system is performing very, very well. And this also ties into waiting for your trade to come to you and therefore not forcing any trades within the market. I think some traders just always want to have risk on in the market. They feel like they always need a position. However, I think if you can get comfortable with not having to execute every single day, for me, I average around 3 to 5 trades every single week. And therefore, there's some days that are more busy, some days where there's no trades. And that is absolutely okay. And so this is lesson number 3, which is, do I have a clear directional bias? Lesson number 3 was amazing, but you will still continue to lose money unless you understand lesson number 4. And a huge problem that so many traders face is having belief in their trading system. The solution to this is simply back testing your strategy, because what this will do will allow you to understand metrics like the max losing trades in a row. So this basically means your maximum drawdown, your average amount of trades every single week. Because let's say you back test a strategy and let's say that it has around 3 to 5 trades a week. If you go in with the mentality that you're expecting 10 to 15 trades a week, then this is going to make you very, very emotional. Because if you can understand, all right, we've got 3 to 5 trades on average every single week, and let's say you have a day where you have a no trading day, then it prevents you from forcing trades, because that is absolutely normal according to your strategy, according to your data, and therefore this helps to increase belief in your trading system. You will also understand metrics like return on investment. For my strategy, we did around 70% in 2024, and this was only trading 2 pairs. And so another metric that you'll understand is your win rate. And for me personally, my win rate is around 50%. And that is with a 1 to 2 risk to reward. So, let's say that I take 10 trades. I already know that just based on probabilities, it's likely that I'm going to lose 5 of them. So, just accepting things like that from the absolute get-go can again really help you to believe in your trading system. And it's also metrics like win rate that will help you work through the drawdown period. A great question to ask yourself is, have you actually back-tested your strategy? If the answer is no, you haven't back-tested, it's very unlikely that you will stick to your strategy. And again, this comes back to lesson 1, you're very likely to strategy hop. If you have back-tested, this will result in increased confidence in your trading system, increased belief in your system, and therefore you are way more likely to succeed. And I think a lot of these lessons just come down to preventing you from strategy hopping. And a lot of these lessons will allow you to then stick with your strategy long enough to actually see the results. So many traders look at trading on a trade-by-trade basis, but the way that I look at it is based on monthly, quarterly, and yearly. Even monthly, I'm not too interested on my return in one single month. And really, it's metrics like quarterly performance and yearly performance that are more beneficial to me. And let's say that you take 12 months of the year. The majority of traders will make their returns in around a 3 to 4 month period. And so even taking a metric of 1 month of data really means absolutely nothing in the grand scheme of things. I think just even having a more zoomed out approach could be very beneficial to you. So these right here are the only 4 lessons that you need. Just to recap, lesson 1 was strategy hopping. Lesson 2 was uniform risk management. Lesson 3 was only trading when you have a clear directional bias. And lesson 4 is back testing your strategy. Are you looking at leveling up your trading? Well, I guarantee to get you funded and consistently profitable in less than 90 days. Make sure to check out my one-on-one mentorship program. The link is in the description down below. As always, thanks so much for your time and support, and you take care, guys. Bye-bye.